The stocks are going to keep going down even though they rally at times, and everything else too. Always behind the curve. They should just stop doing this. All they do is exaggerate these cycles and make them worse. The economy needs a recession. The economy needs to flush out the highest debt levels in history.
In today's video, Harry Dent, author of 0 Hour, talks about what's up with bonds, the next moves of the Fed, the raging inflation and the coming recession. Dent has been predicting a great reset of the biggest financial asset bubble in history. The market historian predicted a painful crash in stocks and an economic depression, and discusses the next moves before the big crash. He believes that the top is in and the Fed is tightening aggressively. Could the markets make a new high? Before listening to him, please ensure to smash the like button and subscribe to the channel.
We've had that credible first wave down, which said for the first time this bubble is very, very likely over. That ended up down 38% on the NASDAQ, 28% on the S&P 500, right in that range for first crashes. And now we're in that second wave bounce. And I keep reminding on our newsletter, we've been in it for about 5 months now. The market's really bottomed. We take it all together around early October. Here we are coming into mid-March, about 5 months later, and it looks like this two-wave bounce. So remember, first wave crash and down significantly to say the bubble's over. Second wave bounce, what you'd expect to be about 50% retracement of that, and we're right in that range. So it looks like this bounce could be peaking now or pretty soon ahead. 3186 on the NASDAQ is my ideal target, but I'm thinking we may not get there. Robert Prechter, my friend, newsletter writer, put out an update yesterday saying it looks like a turn point here as well. So I think, if not right now, soon these markets are gonna start to head down again. Now, I get a lot of questions, people are a little confused over TLT, that's the 20-year Treasury bond ETF. ZEROS is the 25-year, which goes up about 1.6 times, up and down as fast. TMF, for if you really want to take a little money and take a flyer, that's the TLT times 3. So what you have to understand about this, and people need patience here. Everybody's like, well, why isn't TLT going up more? TLT is your only option once stocks start going down. Okay, so last year, you either can be in cash or in high quality treasury bonds, because stocks are going to keep going down even though they rally at times, and everything else too. But the key, and I've shown this in the past, and I'm going to show this in the April newsletter again to remind, what the treasury bonds do, they go up modestly in the early stages of the crash, and then when it gets nasty and everything goes down and gold joins and commodities and stocks and everything really get hit hard, like in late 2008, that's when TLT shows its stuff. That's when the 10 and 30-year treasury bonds rallied the most. So you have to stick with this. Don't expect big gains now, but it has gone up. And I just gave a second buy signal. The low was 92 when TLT backed off to 99, and it's already been back up to 106, 107. I think it's 105 today, okay? So it is moving, but don't expect, the fireworks until later, and it will be your best friend if this is a repeat of the 2008 financial crash. And what do I say about that? Times 1.5. Everything about this, the stock crash, the unemployment, everything should be 1.5 times roughly what the first crash was, because the central banks didn't let that downturn be the 1930 to 32, 33 it wanted and needed to be after the greatest bubble in history, okay? So again, be patient on TLT. Hold this, okay? And again, I told people you can add some 99. Now, recently, for people who want, the only way to make more money in the earlier stages, and now we're going from the first wave down, hopefully starting the third wave, which should be as larger. The way to make more money in the early stage is to be short stocks. Now, a lot of people don't like to do that. Stocks are more volatile. That's why I like the TLT, the treasury bond play. It's not as volatile. But I just gave a buy signal yesterday at 31 on SQQQ. It looked like that was making a credible low and could bounce very significantly from now. That would confirm that the third wave is now heading down after this second wave peak. This is not totally confirmed yet, but that's starting to look like we may not get to that 13,186 number on the NASDAQ, and we may be turning down now. So the other important principle I want to get to people, 12-month lag, okay? And this is why the central banks are kind of cursed from the beginning. They are always behind the curve for two reasons. They wait until there's signs of overheating and inflation, which means it's already well in process and kind of hard to stop. And then their actions to raise or lower interest rates take 12, sometimes as much as 18 months to fully hit the economy. So what we're sitting here right here in March with them finally, their tightening efforts, they started a year ago, okay? 12-month lag, the economy should just start to be really feeling that now and into early to mid 2024 on that 12-month lag. So this is why the Fed, like I say, is kind of cursed, okay? They're going to wait until it's clear, and then their impacts are going to happen 12 to 18 months later, so they're always going to be behind the curve here, okay? So the economy should start to show signs of weakness right around now from this already 475 basis point rise, the highest we've seen in decades, okay? This was a serious hike because the Fed had to make up for overstimulating in COVID, which was the stupidest single move of central banks I've seen in history, to overreact to a obvious short-term crisis, okay, that's going to go away on its own. But why did they do that? Because they've been having to stimulate this economy nonstop since 2008 crisis, okay? They thought it'd be a year into 2009. That'd be their last stimulus. They didn't understand the baby boom had stopped spending forever and the millennials were not coming for a good while. They don't understand the economy's fundamentally weak, so they just keep responding. So that's the problem with the Fed. All they do is react, and then they react a little late to any major trend, and then their stimulus takes another 12 months. They're always behind the curve. They should just stop doing this. All they do is exaggerate these cycles and make them worse as a general rule. We don't need the Fed to tell the economy when it needs to take a break. The economy knows when it does that, and I have said this a million times, especially in the last year. The economy needs a recession, damn it. The economy needs to flush out the highest debt levels in history, the highest rate of zombie companies, large public companies that cannot pay their debt service and are only barely staying alive by not doing that. And then you get a downturn and they're going to be, throwing up all over the place. That's where we're at. The economy booms and it busts. The boom's about 2/3 of the time and the bust about 1/3, okay? Bigger and larger, and we're in a big run up, the longest in history now. The longest, at least in many, many decades, early 2009 into late 2021, okay? A boom in stocks and the economy, okay? And it's just starting to come apart slowly at first, okay? This has been the longest and biggest surge, and most importantly, it's been 100% artificial against fundamentally weakest trends since, the 1970s when the Bob Hope generation stopped spending and we had high inflation. Well, now we're in a slowing, deflationary leaning economy, and the central banks really hate deflation because they know that's when you get the biggest business failures and unemployment and stuff. So the Fed's fighting a losing battle, and they're fighting it late. So what we need to see now, what I am patiently waiting on, the stock market needs to confirm that we're going into a recession, and it's going to happen anyway now that the Fed's got caught overstimulating and forced to tighten, and they cannot reverse that too quickly. They went down to 25 basis points instead of 0. Why? They don't want to look like the old regular. They'll probably do maybe one more 25 basis points at most, but remember, all this tightening, that'll be 500 basis points by then. Huge tightening when you add it all up, okay? And in a short period of time, we'll hit the economy in the next year plus, well into next year. So they've already done the damage. So does this turn around and loosening a little bit by them make enough of a difference? I say not. I think the economy is going to show its weakness in the next year, and it's going to be hard for them to turn around and loosen aggressively. They'll probably just pause soon and then wait and then loosen. And what will they be? late again. We'll already be down in a recession. Stocks will already be in their third wave down, heading towards 50-60% down. People are going to get scared, and it's too late. And then their loosening will take a year to hit, when the economy would have recovered anyway by mid to late 2024. So that's where we're at. Just understand the Fed. They're trying to do something that is not good. They are not, what they're saying is they're smarter than the economy. They're smarter than God, I call it, okay? The economy's God here. It's the voting of all, the stock markets. The markets are the voting of all investors around the world. You know, the whole collective investor base. And consumers drive the economy in the same way, when they all spend at certain times and don't, okay? The Fed shouldn't be fighting this and acting like they're smarter than God here, okay? Smarter than the economy. Cannot have booms without bust. If you don't want to have a serious recession, don't have a bubbly boom fed by tons of stimulus, as we've already done since 2009. So that was the mistake. So forget the Fed here. They're going to be late again. We should be looking at the economy showing signs of weakness, and we're looking for the NASDAQ to break that 10,089 low. So as soon as it hits 2,088 and keeps going, we know we're in this deep down. In other words, the markets have now confirmed, despite everything the Fed's doing or expected to do, nope, we're going down anyway. And I think that's the likely